at a conference, and he came to a little soiree we throw in Las Vegas in the fall, and so we got to know each other very well. And he's been on Trade Thirsty a couple of times, but the way that he uses candles and his short-term, medium-term, long-term approaches to the markets using options is very effective. He's got a track record. He's been around a long time in the markets, and just an all-around good guy. So I've invited him here to speak with you guys tonight. I am speaking Alabama English, Earl. Earl, where are you from, Earl? Yes, Ross, we are going to make recordings available. It takes us a couple days to get those produced, and my team over here will work feverishly to get those out to you in the next 48 hours. So a little patience and we'll get them to you. And we also do post them on Trade Thirsty's website. If you go there, you can see last month's recording, and it probably still has the registration up for tonight. But those will swap out. And if you are looking at next month, we're doing a Saturday event. It will be April 23rd, Saturday, April 23rd. So mark your calendar. Let me turn the mic and the power over to Serge so he can crank up his PowerPoint here. And I'm being told our recording has been rendered, and we're moving on to the next one. So Serge, you should, there it is. Boom. Can everybody see that? Yes, yes, yes. Alabama English. You're welcome, Sandy. Thanks for coming tonight. All right. Serge, I cannot hear you if you're talking. It looks like your mic is open. Just give me a sound test.
Yep. Can you hear me? How's that?
Shaboom, I hear you. Happy Wednesday to you, my friend. How are you?
Good, good. How are you? Everything good?
Everything's good, except for my internet, some puking kids. I got it all good and dandy here in South Alabama. So, but you know that story. So anyway, okay. I know. Okay, 7:06. We stole 6 minutes of your time, but you're last for the evening in presenting. So as long as you try to get to your Q&A by the top of the hour, so those that have planned the rest of their night somewhere else, you can stick around as long as you like, buddy.
Excellent. All right, thanks, Jeanette. All right, good evening, everyone. Hope everyone's doing great. As Jeanette said, my name is Serge Berger, and I'm the founder of TheSteadyTrader.com. I think you made a great choice to attend this webinar today. What I do is I help traders and active investors reach a level of consistent profitability that they never thought possible. Did you know that the reason why most traders are not making money is because they overcomplicate things? That's right. Most traders make things much too complicated. So today, I am going to show you guys a highly profitable three-pronged trading approach that has not only made me a ton of money over the years, but has also already allowed hundreds of traders just like you to live a life of financial freedom by reaching consistent profitability. How would you like to be able to get up in the morning and not care which direction the market is heading, because you know you have a simple, trustworthy, and most importantly, a repeatable process that consistently keeps you on the right side of the market? Furthermore, how would you like to be able to do this from a beachside hotel room in Hawaii or your slopeside hotel room in the Alps? Well, that's actually a very realistic lifestyle to have if you learn to follow this straightforward three-pronged trading approach that I'm going to show you guys today. Financial freedom is what many traders aspire to, and my three-pronged trading approach has allowed me to live a wonderful lifestyle where I spend part of the year here in sunny Florida and the other part in Switzerland. Success as a trader is really not that difficult, and with the approach I'm going to show you guys today, I know that everyone can do this. So what we can talk about today is the one candlestick pattern that's literally going to change your game or your year, depending on how you want to look at it. Okay, so a little bit about myself to give you a bit of a sort of an overview. I have been very fortunate throughout my career to work both on the sell side and on the buy side. So worked at JP Morgan, various hedge funds and family office and things like that. And not only that, but what I've been able to do is see multiple asset classes. So I've been able to see the fixed income world, various derivatives markets, and of course equities and equity markets and equity derivatives as well. So all of that has allowed me to see how some of the very best traders in the world actually make money in the markets. And now as a money manager and through my subscription products, I'm able to pass this knowledge on directly to my clients and my broader audience, such as yourself, this evening. So, as I alluded to in the introduction, I am a very big advocate of keeping things very simple because I really don't think trading and investing has to be complicated. So, most traders and investors make things much too complicated because really what ends up doing is they look at way too many different conflicting data points. Especially in this day and age, we have to be able to eliminate the noise. If we can eliminate the noise, we have basically almost won half the battle. You know, with social media and email and everything we get every single day, we have got to be able to eliminate the noise. The more straightforward our process is, okay, the easier it is to be able to actually stick with it. Okay, think about that. The more straightforward your process of investing and trading, the easier it is for you to actually stick with it. In fact, the best professional traders that I know have a very simple but a repeatable process. Many traders at investment banks or hedge funds only focus on a handful of stocks, but they are really, really good at those stocks, okay? In fact, the two very best traders that I know, they only focus on one, maybe two types of trading setups, if you will, but they are amazingly good at those setups. So this begs a question: if the very best traders only focus on one or two strategies or a handful of stocks, then why do many private traders think that they need to become a jack of all trades when the pros don't even do that? Well, the key to success as a trader is to become an absolute expert at one or two type of setups and then look for those setups to occur across the equities, across the indices, across even different commodities and even FX markets, if you will. Okay, so that's that. What I'm going to show you guys today is a very, very effective and repeatable three-pronged trading process. Everyone can do this, and I really think that at the end of this presentation, it's going to literally change the way you look at financial markets. All right. Let's quickly do a bit of an exercise before we get started, and you can answer this to yourself, or if you feel confident enough, you can type it into the question box. But I have found that it's important to constantly reevaluate where we are at in life and in trading in order to continue to learn more. Well, if you are in the stage number one, and then you're likely a beginner, you're reading, studying, you've never actually done a trade. If you're in stage number two, you've done this for a couple of years, you're going through the initial emotions, sort of fear and greed and that kind of stuff. And if you are in the third stage here, you probably have done this for years, but you're still losing money, or at least not making as much money as you would like. And the good news is that if you are in stage number three, the good news is that you are probably very close to making this work because you have stuck it out this long. I've seen many traders stick it out, and ultimately they make it work after a few years. Okay, so just wanted to give you guys a little bit of an exercise there, to see a lot of 2s and 3s, some 1s trickle in. So it looks like we have a pretty diverse audience. So that's really good. All right, excellent, and a very engaging audience, I will say. That's great, excellent. All right, so just real quick on the agenda, just so you know what I'm going to talk about over the next 40 minutes or so. I'm going to explain to you guys why identifying investor mood or emotions is critical to success as a trader and investor. I'm going to show you guys how to consistently find the highest probability points to buy any given stock, index, commodity, or currency for that matter. I will then tie all this together and give you guys the blueprint to this amazing three-pronged trading and active investing approach. And as a bonus, guys, I'm going to reveal my absolute favorite option strategy that you can implement right away to generate monthly income. Okay, so I hope you guys are excited. Let's do this. Okay, now I understand that some of you guys, or maybe a lot of you guys, already know a little bit what a candlestick is, so I'm not going to go through sort of the Candlesticks 101. I'm just going to give you guys a quick overview on that, and then we'll head into the meat of the presentation. But let me quickly say this. I think there are way too many candlesticks out there, candlestick patterns out there to learn them all. I know a lot of guys out there are trying to teach you thousands, or not thousands, but maybe many dozens of different patterns, and I can tell you, for the most part, most of those are telling you the same thing, so there's a trick to it, but that makes this whole stuff a lot easier to you. So I use the most profitable ones, and basically those are the ones that work. The most profitable ones and the patterns that work, the candlestick patterns, are the ones that show up the most frequent. Okay, now let's quickly go through and look at this little bit as an overview. So what we have here is the candlestick here on the left with the black body, or the filled body. This essentially was a down day. You can see we had an open at this point, we had a lower close, but an intraday range that extended beyond the open to close range, right? And then of course the opposite of that would be an up day, right? We have an open here, a higher close, and a range that extends well beyond that open to close range. What we call this middle bit here, these square parts, that's the body of the candle. And then the stuff on the other end is essentially some people refer to as a shadow, a leg, anything, or a tail, right? So that's what this is. Now, the most important part of this high, low, open, and close relationships, or these 4 points, to me is the close of that candle. And by the way, what I'm going to focus on today, the reference point is that these candlesticks, they're going to be daily candlesticks for me, so daily time frames. Now, you can use this in 5-minute time frames, you can use it in weekly time frames, and whatever you want. For my purposes today, I'm going to use daily time frames. Yeah, someone's saying wicks as well. That's correct. You can call them whatever you want, these little bits here. So, the other thing, guys, about candlesticks is that they're very visual. And the fact is that more than 60% of us have a much easier time learning or seeing things with a series of pictures as opposed to just like, a bunch of words or numbers, right? So if we think of my 3-year-old daughter, she has a much easier time comprehending something if I show her a series of big pictures, right? So that's the thing about candlesticks. They're extremely, extremely visual, right? Much more visual than a bar or a line chart. In fact, if you are using a line chart for some reason for trading, this is going to be a real enlightening presentation to you. Line charts are really good to plot, say, like a GDP or an economic data point, but they're really bad for trading, right? So make sure you use candlesticks. What we have here is a clear visual representation of what's happening on the chart. And by the way, guys, I'll say I'm doing Q&A in the second half of the presentation. If you could hold your questions until then, that'd be awesome. But we're going to get through all your questions. No worries there. So what we're going to get is a very clear and visual representation of the chart, of what's happening, right? But most important, guys, and write this down, what candlesticks do is they display not only price action, but what they really do is they display investor sentiment and footprints, okay? And the candlesticks allow us to judge investor sentiment and footprints, and that's the real key, all right? So let's move on. Now, the other thing with candlesticks is that they just work, right? Furthermore, the formations, as we would call them, are very, very easy to spot once you've trained your eyes a little bit. It's really not hard. It's all about decision-making without emotions, right? So when we enter a trade using candlesticks, and the method I'm going to show you guys today, we have very defined risk and very clear stops. Now, I chose a picture of this person here walking on this cliff because you can see he or she has some very defined risk. I mean, her risk or his risk goes from this point right here, goes from 0 to like 100% instantly, right? So it's the same thing with candlesticks. We know right away when we get into a trade where we need to get out, because we know if the stock or the underlying asset, whatever it is we're looking at, is going above or below a certain point, the risk dramatically increases. So we know exactly what to expect from a risk management point when we get into the trade, and that is worth so much. I cannot even emphasize that enough. So let's look at some types of candles that I think everyone should know and everyone should really get to understand also through the lens of investor psychology. And I'll show you right now what that means. Okay, so this is called a hammer candle. Again, we're going to keep this very simple. You just look at the one up here, the number one, this hammer up here. Forget the other, they're all the same, okay? But the hammer candle is very important at the bottom or near the bottom of a swing or a trend. Okay, so let's look at this day here. Let's assume the market had been, whatever the market is you're looking at, a stock, an index, commodity, whatever, had been dropping for a few days, a few weeks, maybe a few months. And we came into this day. The market opened here, and something happened intraday, and the market continued to push lower, and the bears really pushed this market lower. Something then happened at this point, and the market turned around very sharply and actually fully or almost fully erased the day's losses and actually marginally closed higher on the day or closed significantly off the lows. Now, in terms of CNBC terms, right, one would say, okay, we closed off the lows, right? You know how they say it on TV? Well, the thing is, that doesn't really tell us anything. There's no emotion attached to that statement. Now, when Bob Pisani tells people that we're off the lows, back to you, Sue, it doesn't tell you anything. Let's look at this through the lens of investor psychology, okay? And what happens is that down here at this point, again, assume we had a downtrend here for a few days, a few weeks. The bears tried to one more time after an already existing downtrend push this market lower. But something happened and the bears completely lost control of the ball and gave it over to the bulls. So the point of maximum bearishness occurred down here. There was no more sellers left. So the last of the bulls has basically turned a bear, and there was the point of maximum bearishness. So there was only one way to go, and that was to go higher. If we can consistently pinpoint the extremes of investor emotions and take the other side of that, we have the easiest time in the world to become consistent, profitable traders. Okay, and I'm going to show you guys a lot of examples on this here in the next 30 minutes or so. Okay, so that's the hammer example. Let's look at another example. Let's look at something called an engulfing candle. All right, now let's look at this example here where we had an uptrend. Let's assume it was a multi-week uptrend. We then came into this day, which is kind of a blah day. And then after an already multi-week uptrend, this stock, assume it's a stock, came in and gapped higher the very next day. Something happened and the market completely reversed lower and not only gave up all its gains on the day, but actually completely engulfed the previous day's price action and closed lower on the day. Now again, in CNBC terms, Bob Pisani would say, we're off the highs, back to you, Sue. Doesn't really tell us anything. Think about it through the lens of investor psychology. What is it telling us? Well, the market's been going up for a few weeks, ultimately came into this day. The bulls one more time tried to push this market higher. The bulls lost control of the ball. They had no more left. The last of the bulls bought, and the last of the bears basically turned bullish. And there was only one way to go, and that was to go the other way around. Okay? So if you look at this stuff through the lens of investor psychology, you have a much higher probability of understanding what these candlesticks mean, a much higher probability of consistently picking the other side of those trades, and a much higher or the other side of investor emotions, and a very high probability of being able to stick to your trading plan. Okay. Now let's look at what this looks like on the examples. So we're going to look at the S&P 500 here. I'm going to blow up this chart a little bit more closely for you guys in just 1 second. Let me just get through the bullet points. Let me get some tea here. So essentially what you had here is the S&P 500 in October 2014. And if you guys might remember, there was a very sharp waterfall-like sell-off. Ultimately, we had exhaustion selling take place, a strong bullish reversal, and ultimately to really put the nail in the coffin, we had a bullish continuation buying day. Okay, let's look at this a little bit more closely. Okay, again, this is October 2014. We had a very strong sell-off, emotionally driven sell-off. The Bears had a field day here for a couple of weeks. And ultimately came into this day. I guess this was like the middle of October. Maybe it was like the 16th or so, I think. And what happened is that the Bears tried their very best to push this market lower one more time. After already declining for several weeks, they came in here, opened the market lower, pushed the market lower, and something happened. They ran out of steam. The last of the bulls capitulated. The Bears reached maximum bearishness. There was no more bearishness left, and the market reversed back higher on the day. Now, it didn't close up for the day, but it closed very, very much off the lows because the Bears ran out of steam. Okay? The next day, similar price action. The Bears one more time tried to push this market lower, failed to do so. The market moved back up. And on the third day, we had a follow-through buying day, and that's really what put the nail in the coffin for the Bears. We had a follow-through buying day, which confirmed this bearish exhaustion down here. Okay, so the Bears reached maximum bearishness. There was no more bears left to be bearish, basically, or no one else to become bearish, and the follow-through buying day raced this market higher. Okay, another example. Let's look at the KBW Bank Index. And again, we'll look at this chart closer up in just a second. This, by the way, is a wonderful index to follow. If you guys don't follow the KBW Bank Index, the BKX is the ticker symbol most of the time, is a wonderful thing to follow because banking stocks are extremely important to follow. Okay, so let's look at this quickly through the headlines or the bullets here, and then we'll look at the chart closer up. So first of all, we had to take place a bottoming process. That was followed by exhaustion selling, a strong bullish reversal, and ultimately bullish continuation buying. Okay, let's look at this on the chart. So this was actually just last October, just a few months ago. What happened here is we had a strong sell-off, if you remember last August. The market then kind of meandered sideways, and ultimately on this day, this was one of the first trading days of October, the KBW Bank Index tried its darndest to try and push below its August lows on this day. See where they put the arrow? But something happened. The banks tried to push lower. Ultimately, they completely failed. The bears exhausted themselves, and the market had only one way to go, and that was to go higher. The very next day, the KBW Bank Index gapped higher, gave us a confirmation buying day, and it was off to the races. Okay, the point of maximum bearishness was very, very visible. Okay, and that's the key to candlesticks. The beauty of candlesticks. If you look at them through the lens of investor psychology, it's literally a game changer for most people. Okay, so look at another example. Again, we'll blow up this chart here in just a second. What we're looking at here is the SPDR, the Spider Gold Trust, the GLD. Okay, representing the price of gold. What we had to take place, this is a bearish example. What we had to take place here is a topping process followed by exhaustion buying, followed by a strong bearish reversal and a follow-through selling day. Okay, let's look at this close up. This also was last October, November, so not very, very long ago. We had a strong rally in the price of gold off those July lows, and you can see the market started topping out here in October, and while there was a pretty clear bearish reversal and bulls getting exhausted up here already, the real selling cycle came, I guess it was one of the last trading days of November. You can see what happened. The GLD gold had been rising, and then on this day, the market tried one more time, the bulls tried their darndest to push gold a little bit higher and maybe revisit those mid-October highs. Well, they completely and miserably failed, completely ran out of steam, and the market reversed lower, completely engulfing the previous 5 or 6 trading days or so of price action. You see how this red candle completely engulfed the previous 5 or 6 candles? That's very bearish. Again, think of what happened. In terms of price, the market pushed higher and then closed lower. It doesn't tell you anything. Think about it through the lens of investor psychology. You had an uptrend. The market tried one more time to rally. It completely failed, and the next day it actually gapped lower, and it was just a complete disaster after that. Okay? If you can consistently spot these extreme bullish and bearish reversals It literally changed the way you trade. So get another example, Hewlett-Packard. Again, we'll look at the chart close up in just a second. What we had here was a downward sloping channel. In other words, a sort of almost like a waterfall sell-off. Ultimately, we had a bullish reversal and a strong bullish confirmation buying day. Okay, let's look at this on the daily chart. And this is a little while back, but it's a beautiful example, and I always like to bring it up. So what we had here is shares of Hewlett-Packard trade in a very narrow channel. Okay, very unusual narrow channel for something like this stock. Then we came into I guess it was like the 8th or something of October in this year, and the stock tried one more time on this day. You can see where this arrow is, to push lower. Well, it failed to do so, and closed well off the daily lows. The very next day, we had a massive bullish confirmation buying day, which in this case also did a whole bunch of other technical good things, like break back above its 200-day moving average, which is this blue line and this red line. It broke out of this downward sloping channel. It did many things on huge volume, by the way. Now, you could also reverse engineer this, as you'll see in just a minute. If you see a bullish rally day like this, go back and see if there was a bearish exhaustion candle in the past, okay, in the near past, okay? Okay, now I want to ask you guys to please write this down. These are the 3 steps to the trade, and the key differentiator between what a lot of folks teach and what I'm giving you here with step 1, 2, 3 is that a lot of folks don't have any respect for step number 1. And step number 1 is really important. Having traded for nearly 20 years, having worked on Wall Street on both the buy and the sell side, JP Morgan, hedge funds, you got it. I can tell you step number 1 is very important, and a lot of people don't give this enough respect. You have got to understand what the broader market structure looks like, and for the most part, what that means is that you have to have some footing of what the current monetary policy environment looks like, and maybe what the economic cycle is like, right? So right now, for example, if we look at monetary policy, well, we're in somewhat of we're sort of in a weird environment actually right now, but it's more hawkish than dovish. In other words, there's more risk of rates going higher, at least by the rhetoric, than them going significantly lower from here, right? We're also very late in a cyclical bull market, in a economic expansion. In fact, economic data and corporate profits in rate of change terms have been slowing dramatically year over year, right? So we are certainly in an environment that is more prone to stocks, in this case, trading lower than higher, okay, in a big picture sense, right? So given that, step number 2 then is to make sure that for the most part, you take your trades in the direction of that trend. Doesn't mean you can't go counter trend with defined risk, but for the most part, make sure you trade in that trend. And step number 3 is what we just went through. You then use the technicals, the bullish and bearish, all the candlesticks and all the stuff I showed you, and I'm going to show you a ton more examples here in just a minute. You use all that stuff to then actually make the trade. And again, you can reverse engineer this. You can start with step number 3. You can go in and look for strong bullish bearish reversals, and then make sure those are they're giving you trade signals in the direction of the trend, and then make sure that trend is in conjunction with the broad market monetary policy structure, cyclicality of the market, and stuff like that. Okay, very simple, but very important. I hope you wrote this down. Maybe take a picture on your phone. If you haven't, this is a really important point that I'm making here. Okay, and it's literally the difference between what a lot of professionals do and amateurs. So the successful professionals do this. Let me put it this way. I've seen many professionals not do this, and that's a problem as well, right? So let's continue here. I'm going to show you guys the same charts we just looked at in a bit of a different time frame to give you an idea of how this 1, 2, 3 step process works. Okay, this is the S&P 500. That's the first chart we looked at before. So step 1, broad market structure. What happened? Well, in 2014, when we had that bullish reversal, right, the broad market structure is still very much bullish. We had the monetary policy being very accommodative, and so when the October sell-off, October 2014 sell-off took place, it bounced right into the 2011 support line. If you had been aware of this support line and realized that we were still in the cyclical bull market being having accommodative Fed, and seeing the strong bullish reversal not only on the daily chart but also on the weekly chart, you would have had no problem buying this dip. And I know a lot of people had a very difficult time buying this dip, but I got a lot of phone calls when this bullish reversal took place from a lot of hedge funds around the world, actually, and I showed them exactly this chart. And I said, listen, guys, step 1, step 2, step 3, here's what we're buying. And we ended up buying, and we had a wonderful couple months going forward. Okay, this next chart is the KBW Bank Index. Now, this is also the same chart I showed you guys before, just zoomed out in a bigger picture format. So step 1, or let's just look at this a little bit differently. Let's understand that there's a multi-year support line right here. Okay, and this is the BKX, again, the KBW Bank Index. And what I showed you guys before was that bullish reversal take place last, I guess it was November, right? And what happened at the time was the Fed was actually talking up rates. So that was going to be bullish for banks for a trade, right? And indeed, it was bullish for a trade. But look where that bullish reversal took place on a multi-year chart. It took place right at a very, very important support line. So had you been aware of this bigger picture, you would have had a much easier time buying that bullish reversal. Okay. Then next we have the gold ETF, the GLD. Remember I showed you that bearish reversal? Well, that bearish reversal last October took place right here. This was right at a multi-year downtrend line with a GLD reversed. Well, we had a funky market, a funky lack of inflation story taking place. The dollar was still going higher, and so none of that was really very constructive for the price of gold. And again, that's step 1. The trend remained lower, so when we had a bearish reversal on the daily chart and it coincided with a multi-year downtrend on a weekly chart, you had a very strong case for taking that trade and shorting the GLD at that point. Okay. In interest of time, we're going to skip this one here. I'm going to give you guys a lot more examples here in just a second. Let me just walk through, and I mentioned I was going to give you guys my bonus options trade. Okay, we're going to do a lot of questions here. I want to take a lot of your tickers, and I want to show you guys the bullish and bearish reversals on the charts that you want to give me. So give me just 1 minute. I want to go through the options setup first. Okay. Now I've been trading options for nearly 15 years, and in different asset classes and different time frames. And I can tell you this is by far the highest probability options trade that I know. Okay. Now it works particularly well on so-called cult stocks or trend follower favorites like an Amazon.com, for example. Okay. So what you need to do is, for example, Amazon.com last year was a stock that took a very steep slope into vertical fashion, right? And what happened then is ultimately the stock exhausted itself. And when that took place, the implied volatility of options started to go higher, and which is sort of counterintuitive, because you would think when a stock goes up, implied volatility kind of gets squeezed. And for the most part, but when a cold stock like an Amazon.com takes a very steep multi-year chart into vertical mode, in like vertical blow-off mode, what happens is implied volatility actually starts rising because market makers and other smart money folks realize that the risk of a mean reversion move at the very least is very high. What that allows for us to take the other side of this is to go out and sell what we refer to as far out of the money calls or call spreads for huge premiums, literally 20-30+% out of the money 1 or 2 months out. I do this trade every single month in multiple stocks in different asset classes. It's the best income strategy I know. You have opportunities for this taking place every single month. So that's a wonderful option strategy. And of course, you can do the inverse. If you have a stock that's falling just to the ground, then as long as it doesn't go bankrupt or there's other systemic issues with it, you can actually sell out of the money put spreads on a stock that's been overly beaten down to the downside. Okay? So that's the option strategy I want to go through. Now, let's go through some more questions. Before that, though, let me quickly go through a summary. Again, what candlesticks do is that they show not only price action, but more importantly, they show us investor footprints and emotions. So what we need to have is a straightforward and repeatable process, because that is the key to consistent profits as a trader and active investor. Again, my three-pronged trading approach is number one, you have got to understand the broader market structure. Very important. Don't have to be an economist, but you have to understand what's going on. Number two, scan for technically sound stocks, commodities, what have you, in the direction of that trend. And number three, you can use your 1, 2, 3 bullish, bearish, reversal signals to actually get into the trade. Okay? Now, let me go through, I'm going to show you guys one example, and I'd like to take a couple of your examples right now, and then we'll do a lot more examples in just a few minutes. Okay, so give me some tickers, and I'd love to look at your chart, see what you have to look at, and we'll see if we can find some bullish and bearish reversals with this analysis. Now, let me quickly show you guys a trade that we did just a little while ago. Actually, this was in December with for clients, and this was a beautiful trade. Remember that engulfing candle I showed you guys earlier, that really strong bearish reversal where the bulls exhaust themselves? Well, Nike had a beauty, okay, and this was on the 23rd of December. Look at what happened here. Nike had been struggling trying to get above $67 area or so in last October and again in November. Well, when the stock then tried to rally above that point in December, it miserably failed to do so on an intraday basis. It quickly reversed lower, fully engulfing the previous few days price action, and the very next day actually gave us a follow-through selling day. You see that? Now, again, look at it through the lens of price action. What happened? Through the lens of price action, we closed off the lows. Back to you, Sue. Right? Doesn't tell you much. Through the lens of investor psychology, you know that the bulls tried their very best to push this market higher for a breakout. They failed so miserably and so badly that the entire rally intraday faded. The stock closed meaningfully lower, and the next day we had a follow-through selling day. Okay? So that's just one example I wanted to show you guys. Let's look at a couple that you guys have, and then we'll look a lot more in just a few minutes. So let's start. There's a lot coming through here. Let's see here. Someone wants to know about First Solar. Okay, now First Solar, again, keep in mind, we're always looking in the direction of the trend, but look at First Solar. One simple trick I can give you guys right now is that the most important price action or the most important psychological shifts is usually represented by the most visually obvious candlesticks, okay? So like, look, for example, here, this was in January. We had two strong bullish reversal candles. You see those long legs, ultimately followed by follow-through and buying day? That was good for a nice trade, right? See how the bears exhausted themselves down here? It happened again a few weeks later, right? This was in February. Market tried to push lower. Bears failed to keep the market down and started pushing this market higher. Confirmation buying day a couple days later, right? So that's First Solar. Chipotle Mexican Grill. Keep in mind this stock has the E. coli issue out there, so that was one of the things. But what I want to show you here is the bearish example. This was a beauty of a trade set up once it actually broke support and it became somewhat more obvious. So let me just quickly make a plain white chart so as not to confuse you too much with these moving averages. All right, but what I want to show you guys here is what happened in CMG, Chipotle Mexican Grill. Okay, look what happened here. Now, we had a stock that had a fairly difficult time in last August trying to get above this $760 area, and then ultimately it tried one more time to push above this area in last October, but it failed to do so. We had a failure to push above those highs. It gave us a bearish reversal candle. The very next day, the stock gapped lower, okay? Gapped lower and gave us a confirmation selling day. And it was just complete failure after that. And again, guys, I'm not just making this up. I'm literally just taking you questions, okay? I'm literally just taking you questions so you can see how often this stuff takes place and how clear it becomes. Once you have the bearish reversal in this case, or the bullish reversal in the bullish case, but you have to have confirmation selling in a bearish example, and you have to have confirmation buying in the bullish example, right? Like, so this is the CMG example. First Solar, that who asked First Solar? Let's see. First Solar was Bob asked for First Solar. So if you look at First Solar, Bob, you can see that we had these strong bullish reversals here that were followed by follow-through buying, and it was off to the races for the trades, right? So the bears exhausted themselves. They completely lost control of the game, follow-through buying day, scared the pants out of the bears, and it was off to the races, okay? Are you guys starting to see how this is coming along? This is real important stuff, okay? Now, let me go through one more slide and then we'll do a lot more examples. There's a ton of questions there. It's really good stuff, guys. Albert Einstein once said that the definition of insanity is repeating the same behaviors and expecting a different outcome. Well, in order to become profitable, we need a plan, and we need a plan that is both repeatable, and all of that starts with knowledge, okay? So if knowledge is what you seek, and I would expect most of you do, I would like to offer you guys my ultimate candlestick bootcamp. What you're going to learn in this 11-part video series course is my institutional three-pronged trading approach that I've learned over the past nearly 20 years working at JP Morgan's, at hedge funds, and all things like that, and the way I manage money right now. You can learn my low-stress, high-probability swing trading method. You're going to learn to nail reversals by correctly reading investor sentiment and emotions using candles and more. And again, we're going to go through a lot more examples here in just a minute. You guys had a lot of questions and a lot of examples you want to look at, so we'll do all that. Okay. Now, what this 11-part video series includes is a 30-page course guide ebook with beautiful charts like the ones we just went through, and you can pick it all up at www.thesteadytrader.com/now. I see that Jeanette's already been kind enough to paste that into the chat box. It's just $97. It's a one-time fee for an 11-part recorded video series and a 30-page course guide. Okay, just $97. www.thesteadytrader.com/now. All right. By the way, guys, there's a 30-day money-back guarantee. So if you don't like it within your 30 days, I really don't want you $97. Okay. Now the question, of course, is who is this course not for? I will tell you that I don't think this course is for someone that can't be patient or disciplined in the trading approach. I don't think this course is for someone who is just looking for someone to feed them every single trade. And it's really not for people that can't make their own decisions. Okay? So you might be thinking, why do I want to buy this course? You know, how is it different from other courses? Well, this course is really meant for people that want to learn how to fish and want to learn to become financially independent. It's really for self-disciplined or disciplined self-starters, I should say, who have enough discipline to follow a three-pronged, rules-based, repeatable approach to trading. Okay, I have perfected, I would say, to the extent one can perfect something in trading, this approach over the past nearly 20 years, working at all these different places, like I said, and I pretty much lay it all on the table in this course for you. Okay, again, it's just $97, one-time fee for an 11-part recorded video series. www.thesteadytrader.com/now. It also includes a 30-page ebook. We'll get back to your questions in just a second. I have a testimonial here from Brian Rekwalski. Brian said that The Steady Trader provides in-depth technical analysis unseen in other sites. And Brian, it's been a pleasure to watch him grow. He was already a professional trader, and he took this course. And again, this course is for anyone from the novice to the professional. It was wonderful to see how steady he's become in making his returns. So you know, if it can help him, imagine what it can help anyone that's not a professional. Okay. Also, guys, you're going to learn, again, my institutional three-pronged trading approach in this course. You're going to learn all variations of the bullish and bearish reversals. You're going to learn how to use candlesticks to trade in the direction of the trend and against it. But I promise you, you're not going to have to learn hundreds of candlesticks patterns because, like I said in the presentation, most of them either don't work or are telling you the same thing that many others are. Okay. Also, you're going to learn my rocket launch and gravity pull setups, and ultimately, guys, and I should really sell this stuff in its own course because this is so valuable. In the course, you're going to learn about multi-time frame analysis and how to trade with confluence zones. Okay, these two things alone are worth like thousands and thousands of dollars. And this is so juicy. Multi-time frame analysis and confluence zones. You can learn about it all in this course and how to use it with using candlesticks. So again, just $97, www.steadytrader.com/now. Okay. All right. Let's get to your questions though. First, quickly, one more. I think it's 2 more slides. You're also going to learn in this course sideways channel breakouts, wedge or flagrant breakouts, lateral breakouts, trending gaps, support and resistance lines, and moving averages and momentum oscillators, Fibonacci retracements. You're going to learn all this stuff, but you're going to learn it for someone who's actually traded this as opposed to someone who's just writing an academic exercise on it. Okay, a lot of folks try to teach you this stuff, basically looking at it as an academic regression. I've traded this stuff in real life, and that's how I manage money now. I've learned it all, the banks and the hedge funds, and I'll teach you how it actually works. Okay. You're also going to learn where to set your stops. You can learn risk management strategy, a little bit about the mental aspect of trading, which is really important. Money management. And yeah, so that's the course. So again, it's an 11-part recorded video series, just $97. It includes a 30-page ebook with beautiful charts like the ones we showed and what I'm going to go through here with you guys right now. Again, the link is in the chat box, www.thesteadytrader.com/now. There's a 30-day money-back guarantee. There's really no risk, guys. All right, let's get to your questions again, okay? So, Bob and Carol, I went through First Solar and Chipotle Mexican Grill for you. Did those examples make sense to you? Let me know, please. Mike wants to know about the S&P. Sure, let's go to the S&P. Okay, so the S&P 500, I mean, the obvious bullish reversals were down here, right? We had some real strong bullish reversals in January, and again in February. You can see the bears completely exhausted themselves down here on the 20th of January. If guys, let me put it this way. So I'm glad Mike brought up the S&P 500. So most people overtrade, right? Just like I said, most people make things too complicated. Most people overtrade, right? So a lot of people will try to do little trades in here, and there's just nothing going on in here, right? But if you can consistently pinpoint these bullish reversals and the bearish reversals, by the way, when they take place in the upside, like here, for example, if you can continually do that, you are giving yourself like an 80%, 90% percent chance to make money right away out of the gate without even further qualifying those trades. Okay, most people overtrade because they're so anxious and they're not patient enough because they only look at a few stocks or a few indices. But if you expand your horizon to like maybe 20, 30 stocks, maybe, a whole bunch of different currencies, maybe different commodities, whatever your market is, and don't just stare at one currency or one stock all day long, and then you will find these opportunities take place every single day, and you'll have a much higher probability of making consistent profits and leading that financial freedom life that you so desperately want, right? That's what I do. I get up every morning, I look at many, many charts, different markets, and I look for these patterns that I just showed you guys. So look at that bullish reversal that took place here on the 20th of January. See how the bears completely exhausted themselves. We had follow through buying the next day, and now we had a trade. Now we retested those lows in February, but we didn't close below those lows. We didn't close below those lows on a daily closing basis. A lot of times when you have a long candle like this after an extensive downtrend, there's a very high probability of it holding. Okay, Mike, does that make sense? Mike, you were asking about the S&P 500. And Johnny was asking about the SPY. That's the same trade, right? So right now, let's see what happens today. So since you guys are asking about the S&P, let's see what happens today. So you can see the market pushed higher today. It closed off the lows, but this is not a bearish reversal. Don't go in and short the market just now. That's really silly to do. Let's wait until the market gives us a bearish reversal. Okay. Let's see. Oh my God, there's a lot of questions. You guys are active. Alrighty. So, Curtis is asking, how do you scan for these stocks? I would ask you to take the course. That's not the simplest question. A lot of people think there's some magic scanner to look for these stocks. you have to build a list of stocks. I can send you a list of stocks you can just go through if you take the course, and you just scan those things all the time. Okay. Susan's asking a really good question. How many days do you wait for a confirmation buying or selling? I will tell you, I usually try not to wait more than 3 or 4 days, because if we wait more than 3 or 4 days, it means that the maximum, in this case, the maximum bearishness hasn't yet quite occurred. But you can see right here, after the January 20th exhaustion selling, it took only 2 days for a confirmation buying day to take place. Okay? The videos, there's no discount for veterans, unfortunately, no. The length of the videos are between 15 and 30 minutes long in the course. Let me see. Yeah, Bob is saying yes, First Solar. First Solar, he got the chart, blah, blah, blah. Calvin, you said you took the course. If you write to Jeanette or the team, they will give you my email address, and then you can write to me. Craig, yes, I do trade a little bit of Forex, and this works very well in Forex. So Mark is asking, do I only use the daily time frame? I use more than just the daily time frame. So this is where it comes into multi-time frame analysis. Okay, you're welcome, Craig. So I'm a big believer of not just staring at using single factor models, so to speak. So don't look at charts just in one time frame. Okay, if all you do, like, I'll give you an example. Okay, I'll give you an actual example here, right? So this is Lululemon, right? This is Lululemon, and I've been highlighting this stock to my clients and subscribers and everything for some time. Okay, let's look at Lululemon. And by the way, if you guys want to go to thesteadytrader.com, you'll find a free video I did today on this stock, actually on the stock setup. Okay. So let's look at this Lululemon trade. So I'm going to make a weekly chart. So what you have to use, and again, you're going to learn this in the course, you want to use daily, weekly, and even closer up time frame. So the analysis on Lululemon is like this. You can see what the multi-year time frame trend is here, right? We had very clear resistance, right, all the way from those 2013 highs, and today the stock finally broke higher. Right? Let's look at this in the daily chart. I'm going to go into a daily chart, and I'm going to show you guys how this chart looked on the daily chart. Look at this. See this? Breakout here, boom, today on the daily chart. Right? Now let's look on, let's see, I play my chart, and let's look at like a 15-minute chart. Okay? And you can see what happened here. You can see the stock just absolutely blasted higher out of resistance, and you can draw all sorts of lines here, right? But use multiple time frames. It's really, really important. When you have these bullish and bearish reversals, like I showed you guys before, it's the same deal, right? So for example, let's get back to the S&P 500 or let's say take the SPY. It doesn't really matter, right? So know the January 20th lows. Let's look at this, what it looked like on a weekly basis, right? Really important, guys. Really, really important. And again, you'll learn this in the course. Look at this. We had a real strong bullish reversal take place on that January 20th week. The next week we had followed through buying. Yes, we revisited, but we didn't close below those lows. That's really important. So that's why these strong emotions here are so important. We actually ended up buying calls here. We sold a little bit up here or somewhere in here, and then we rebought calls down here. Actually, we didn't know we sold put spreads. I'm sorry. But anyway, we made bullish bets, right? So we doubled down once we got here, and we saw that this held. Okay? So Laura is asking a good question, and he's asking, do I trade candlestick patterns that are called 3 black crows and 3 white soldiers? I've done this for nearly 20 years. I've never heard of those. Now, it doesn't mean those don't exist or that those are not important, but what I'm trying to teach you in this course and in this, what I just told you for the past 60 minutes, is that those names and all that stuff, as much as that sounds nice, it is, in my opinion, is quite nonsense. Because if you look at all this through the lens of investor psychology, it doesn't matter what the heck the pattern is called. If you can see the bears puking down here and they're following through with buying the next day or the next few days, it doesn't matter what this is called. You are seeing visibly on the charts that the bears are exhausting themselves. Or in the case of Nike here, right? Remember that example I showed you guys before? You don't need a funky name for a reversal to see that this was an ugly bearish reversal day up here on the 23rd of December. You don't need a funky name. You see that there was maximum bullishness exhausted itself, so there was only one way to go, and that was to go lower. Okay? Are you guys, this makes sense to you guys? Let's see. There's a lot of questions for. Someone wants to look at Intel. This was Dale want to look at Intel. Okay? So right now, if you're asking me right now what's Intel doing, I think Intel could start closing some of these gaps up here. Gaps are when you have these spaces in between these bars, in between these days. Intel basically has a lot of resistance here. And by the way, there was a bit of a bullish reversal. Okay, we've so far focused on the extremes, right? But there are bullish reversals and bearish reversals through the lens of investor psychology taking place in closer time frames as well. So look at Intel, for example. Right? So Intel, in the past few days, I'm going to zoom in a little bit closer, and let me use the 8 and 21-day moving averages, which I would suggest anyone to use, by the way. That's a little freebie I just tossed in there. Hope you guys like that. So if you see what happened here, you can see over the past few days we had a couple of bullish reversals. The bears failed to push the market lower. We had a buying confirmation day 2 days ago when the broader market rallied, and further confirmation buying today. You guys seeing this? So this doesn't just work at the extremes down here and up here. It works in the middle as well. You just have to look a little closer, and that's exactly all the stuff you're going to learn in the course. Okay? Let's see. Let's see. Darren is asking, do you use net change bar open versus closed bar for candle? Okay, so she's asking a bit of a more in-depth question. I would say take the course, because I basically go through it there in more detail. But what she's asking is basically, is there a certain, like if we go back to the SPY example, just because it's the easiest one, everyone knows the S&P 500. She's asking sort of, what's the size of the body of a candle versus the entire candle, or versus, that kind of ratio stuff. I will tell you that for a confirmation buying day, let me put it this way. For a confirmation buying day, I need to see a real solid buying day that gets above the highs of the selling candle. Like, so for example, in the SPY, to me, on the 20th of January, right, that's your selling candle right there. Let me highlight this. This is your selling candle, okay? And the next day, to me, yes, we had an update, but that wasn't good enough yet. I needed to see a daily close above the high of this candle. That happened 2 days later, because I really need to see that the bears down here really, really get scared, okay, and they start covering and they start running for the hills, okay? Okay, Michael was saying yes for that other trade there. Alrighty, Mark wants to know a lot of immediate term actionable trades. Well, I showed you one in Lululemon just now. That was a bit different one, but I tell you, for example, I'm a little bit. I mean, this is not confirmed. Well, I showed you one. I gave you two. I gave you a freebie already. I told you the SPY. If it has a confirmation selling day coming up, then I think today's reversal was something to take notice of. Facebook. Okay, I'll give you another example in Facebook. So we had a beauty of a trade in Facebook in January on the short side. Look at that rally, with that very strong rally. I guess it was inter earnings. I don't exactly remember. But then look what happened on this day. This was the 2nd of February. Okay, and the market pushed higher, failed miserably, stay at those highs, closed unchanged on the day, but the next day pushed lower, and it was off to the races lower. So this came after a very strong, unsustainably steep rally. The market gave us an intraday rally fake out day. The next day we had selling pressure and it was lower. Now, okay, the SPY, or the Facebook had another strong run, and today see how it tried to push lower once again above yesterday's highs. It failed to do so, and it actually sort of cut into more than half of yesterday's candle. Let me make this a little bit closer for you guys. And again, guys, think about this through the lens of investor psychology. I can't tell you how important this is. Don't just look at it as price action. Look at it, what is happening through the lens of investor psychology. Today's price action, to me, tells me that the bulls are getting a little exhausted here. Today, they tried to push this Facebook stock a little bit higher. It reversed lower. Yes, we still need to see a confirmation selling day, but we've had initial exhaustion on the part of the bulls, okay? Maybe the last of the bulls bought today, I don't know yet, but this was an initial warning sign, okay? So that's your second freebie there, Mark. Dave, just going back to the SPY, okay? I'm just repeating what I said before in the SPY. I think the SPY could potentially be nearing a bearish reversal. Again, purely technically, what we can look at is the S&P 500, because the S&P 500 is really sort of where you want to look at, technically speaking. So we closed fairly well off the day's high. Let me use the 821-day moving averages here. Okay, so you can see what happened today. The SPY closed off the day's highs. It gapped higher today. Okay, can you see that? It gapped higher today. Let me use the arrow. It gapped higher today, and now we need a confirmation selling day. So we need a confirmation selling. That's what I keep telling people. Unless we have confirmation selling, nothing's confirmed. Okay, we need confirmation selling that the bears or the bulls exhausted themselves up here. Okay, and all this stuff, guys, you're going to learn in the course. Again, it's at thestudytrader.com/now. The link is in the chat box. Jeanette was kind enough to put that in there. It's just $97, a one-time charge for a 11-part recorded video series. You're going to learn all this stuff. Includes a 30-page ebook, okay, with beautiful charts just like this. So go ahead and take it. I think it's going to make a world of difference in the way that you approach the markets, the way you become more consistent in your process, the way you can stick to your process, and you're going to become much more selective and patient as a trader. And that's what I see when I work with people, and I know this for myself. The more patient I am, the more I only look for the high probability setups, the better I get. And using this stuff that you're going to learn in the course, looking at markets through the lens of investor psychology, is going to make a massive difference in the way you trade. So I'm going to leave it at this, guys. So thank you everyone for your attendance. I'm going to put this back over to Jeanette. Jeanette, thanks so much for having me, and I wish everyone a great rest of your day.